I think we can start now, right? So, we have this cost of capital. I think you remember. Last week we started this topic. We done up to cost of preferred stock. Right? So now you know what is cost of capital, why it is important, and in order to estimate the overall cost of capital, so you should know how to determine the component cost of capital. So cost of debt, cost of preference shares, and the cost of equity. So you remember that. So we finished this cost of debt calculation. So especially you have to remember when you are estimating cost of debt, you have to consider the tax shield, tax saving. So I think you remember that. When it's come to the cost of preference shares, no issue. So the investor required rate of return, preference shareholder required rate of return, you can take as it is as the company cost of preferred stock. So today we have to continue from here, cost of equity. Right. So when it's come to the cost of equity, equity capital can be two forms, that is internal equity and the external equity. Internal meaning, you know that when the company is earning profit, they retain some profit for the reinvestment purpose. So that retaining profit or the retained earnings belongs to the equity shareholders. So without paying this profit as dividends, company deciding to keep it with the company for the reinvestment or the future investment purpose. So therefore, when it's come to the equity cost estimation, so we have to consider these two: cost of internal equity and the cost of external equity. So external equity can arise when a company is issuing new shares. Right? So company can raise additional equity capital by issuing new equity shares, ordinary shares. So that is the part externally. So now if I ask a question for this internal equity part, for the cost of retained earnings. So retained earnings means that company earned profit, internally generated profit. That is the internal equity. Is there a cost for that? This internal equity part. What is the cost? What is the cost? So we have to estimate that cost of internal equity as well as cost of external equity. Are there any costs for the internal equity? Yes. That is actually the opportunity cost. There is an opportunity cost. What is that? If this retained profit, if company pay as dividends, suppose you are an investor. If you are receiving certain dividends from a company, so what you could do? You can reinvest it. You can invest in another investment. So you would have earned some return. If you are receiving dividends, you would have earned some return. But now the company has retained their profit. So then you have lost that opportunity. Right? So there is the opportunity cost with the retained earnings. So that is we have to consider theoretically as the cost of internal equity. So normally company decide, you know that dividend policy, when it comes to the dividend policy, there are two. That is retention ratio and the payout ratio. Retention and payout. So when the company is deciding to increase their retained profits, when they decide to retain some amount high, so it means that this particular company has some good investment. So they need some money for the investment purpose. So therefore, in future, in long term, these investors might earn some more return through this value generated, value created investment. So then, if company is retaining profits for the reinvestment or the investment purpose, so the director board or the finance manager should have some confidence that they can earn more invest in this particular dividends. Right? Management should retain earnings. So you can see this point. Management should retain earnings only if they can earn as much as stockholders' next best investment opportunities at the same risk. So that is the meaning. So now if you are receiving these dividends, you would have, there is an opportunity to invest. Now company is retaining this profit. So then company should assure, there should some confidence that they can earn as much as or more than that. That shareholders can earn from their next best investment opportunity. So that is the theoretically opportunity cost. Right? So theoretically, cost of internal liquidity mean that is opportunity cost of the next best investment opportunity for that shareholder. That is theoretically. So opportunity cost of common shareholders funds we can determine. There are so many models, but here we discuss only these three. Dividend growth model already done. You know, we applied this where? We applied this where? Then when we calculate intrinsic value for the equity shares. Do you remember that when the dividends are growing at a constant rate for a future indefinite period, so we applied dividend growth model to calculate the intrinsic value. Same model we apply here to determine the cost of internal liquidity. Capital asset pricing model. Do you remember that? CAPM. Before the last week, we finished it under the risk and return. So this CAPM model we applied here to estimate the cost of equity. The other one is bond yield plus risk premium method. That is very simple method. So these three methods we discuss under this cost of internal equity calculation. So when it's come to the external equity, in addition to this consideration, we have to think about flotation cost or issuing cost. Because when a company is issuing new ordinary shares, so they have to pay certain issuing costs like charges for the underwriters, some commission, documentation charges, stamp duties, certain expenditures are there when the company is issuing new shares. So that part we have to consider when we are calculating cost of external liquidity. So we call it as a flotation cost. So that considering same models we are applying here for that also to estimate the cost of internal liquidity and the cost of external liquidity. So let's go with the dividend growth model. I think you remember this one. When a company dividend growing at a constant rate, so the value or price in market is efficient, you can determine next period dividend or the dividend immediately after the start of the constant growth. You can turn back and you can see that model. Divide by what is value or the intrinsic value is equal next period dividend divided by investor required rate of return, or we can define now here it is as the cost of external liquidity minus constant growth rate. If the dividends are growing at 10%, so that is the constant growth. So the same model we apply here to determine this. So then cost of external liquidity is equal D1 divided by price or value plus growth rate. So that same application we apply here to determine the cost of equity. So therefore nothing new. This model we applied in the security valuation under the ordinary share valuation. Remember this one? You have a final quiz today, no? I have scheduled it around 2:30, no, 2:20 to 2:50. Is it okay? Because I'm having the two sessions today. How does it like? Or if you need in the this session, I can change time. Somebody all are half day will allow you in another can someone to do it. Right. So this is all about the dividend growth model. That's on the risk aversion. Right. So now look at an example is there. Market price of a share. Suppose that particular company market price of the stock equity share 30 rupees. Dividend just paid. Recently paid dividend 4 rupees per share, and this company now in their maturity stage is a stable company. In the life cycle, they are in a growth level. So then dividends are expected to grow at the rate of 8% for a future indefinite period. So then you want to estimate cost of equity. You want to estimate cost of internal equity. So you cannot apply capital here because market information is not there. No information to apply the capital. In order to apply the capital, you should know the market risk premium, market return, risk-free rate. If these informations are available, so then you can apply capital to determine the cost of internal equity. But in this example, you are provided with the dividend information. So then based on the dividend growth model, you have to calculate cost of internal equity. So what is the answer? What is the answer? Normally we are using KS, right? Don't worry about that symbols because they are changing with the textbooks and the things. So normally we are using KS to indicate the cost of internal equity, KE to indicate the cost of external equity, KP cost of preference shares, KD cost of equity, sorry, cost of debt, D for the debt capital, E for the preferred stock capital. Right. Here this equal D1 divided by price plus growth rate. Here this price we assume as the intrinsic value on particular assumption. This is the market price, 30 rupees. So we suppose this market price as the fair price, or we consider it as the intrinsic value. Under the assumption of, what is the assumption? For the exam, you will have some theoretical questions also. I am planning to have 50-50. Theory-based question and a 50 calculation. Because I know that some students are scoring with the calculation, some are fine with the theory. So therefore, 50-50 will have on theories on this descriptive type answers I am expecting. Now suppose now in this example, 30 rupees is the market price. So when we apply this model, we consider here value, price, market price, value. Value is the intrinsic value. So this market price we consider here as the intrinsic value. So when the market price is equal to the value, so we assume that this is a fair pricing, no undervaluation, no overvaluation. So market is efficient. Market is efficient. So with that assumption, अभी इतना ना market का fully efficient. Market is perfectly efficient. So suppose in life, assuming that So we consider here the 30 rupees market price as the value. Right? Under that assumption, we apply this one. There is some way. When they got the rates of growth, you know that there can be undervaluation and overvaluation. Mathematics secret valuation or undervaluation we buy, overvaluation we sell. So likewise, you have to take decision. But here we assume this 30 rupees as the value, intrinsic value, under the assumption of perfect market efficiency. Right. So what is the answer? What is your answer? D1 is how much? 4 rupees. D1 4 rupees ගන්න නම් ඉතින් දැන් නම් ඉතින් මේ ඔළුවේ තමයි හිටන්නේ. මොකද දැන් අපි මේ apply කරලා models security evaluation කරලා ඇවිල්ලා තියෙන්නේ. D1, this is D1. D1 means immediately after the next period. So this is just paid. In the question, hondara given prashne, if you are given in the question just paid or recently paid dividend. ආසන්න වශයෙන් ගෙවලා තියෙන ලාභාංශය කම්පැනි එක. මේ දැන් ගෙවපු ලාභාංශය just paid. It is 4 rupees. Is it D1? Huh? No, it is D0. සමහර විට ඔයාලට D1 දෙන්න පුළුවන්. ඒතර ගානේ D1 දෙන්නොත් ආයි D2 යන්න එපා. D1 ගන්න. දැන් මෙතන තියෙන්නේ just paid dividend is 4 rupees. So this is D0. D0 is equal 4. So if you know the growth rate, so then you can calculate D1 equal should increase by 8%. Growth rate is 8%. So then your D1 is how much? 4.32. 4.32 divided by price or value 30 rupees plus growth rate is 8%. So your cost of external equity, this information, how much? 22.4. 22.4. So this is the dividend growth model. So when we apply this dividend growth model, certain assumptions are there. We are assuming that earnings growth is constant, earnings are growing at a constant rate, so dividend payout is a constant rate. So likewise, certain assumptions are there, so we are not touching in deep this assumption. Now basically we assume that dividends are growing at a constant rate for a future period, for a certain period. On that, we apply this dividend growth model. Okay? Theory ප්‍රශ්න අහනකොට ඉතින් ඔය වගේ දේවල් අහන්න පුළුවන්. ඒතකොට ගණන් හදනවා වගේ මේවත් චුට්ටක් අවබෝධයෙන් එනවා. Some of you may morning asked me to discuss some model paper. Yes, in the last lecture I will allocate some 30 minutes slide to explain the model paper. Very similar to the previous one. So I will give some hints, so then you can prepare them. Right? Right. This is from your hint, I think. Yes. A company common stock is currently trading at 163 per share. Stock is expected to pay dividend 350 share at the end of this year. Right? The stock is expected to pay dividend 350 rupees per share at the end of this year, and the dividend is expected to grow at a constant rate of 8% per annum for the unforeseeable future. So determine their cost of internal equity. So again you have to apply this dividend growth model. So what is the answer? company or the stock is expected to pay dividend 350 end of this year, at the end of this year. Now is it D0 or D1? Huh? D1. This is D1. No need to estimate the D1. So you can take this as the D1 350. If I ask what is the D0, you can calculate. Making percent the Srilanka. That is D0. Now this year the company expect to pay 350. So this is D1. How much expected to pay this year, end of this year, 350. So this is D1. Divide by price, 163 plus growth rate is 8%. The answer? 10.1. Then make a D0 here, hit it, ignore it, chutak. Opposite the number come up with, right? Then make it the dividend expected to pay at the end of this year. So this is not the D0. This is D1. Right, this is related to the previous question. Now, in case this growth rate is not given, right? Suppose the growth rate is not given. So normally I told you that companies or these PLC companies also, they have their life cycle. So they may have a certain period with the initial growth, then rapid growth, and then become very stable or the matured situation. So then when the companies become well stabilized, when it is well matured company, so they are maintaining a constant growth rate for a long period. So they can increase dividend 10% each year because their earnings growth is constant. So they are in a stable situation. Now in case if the growth rate is not given, growth rate is not given, so then for an established company, this in the theoretical it is saying that when a company has history like past 5 to 10 years, so while looking at their past dividend per share information, you can estimate the growth. So that growth rate you can take as a constant growth. When a company has their history 5 to 10 years, right? 5 to 10 years life period. So then you can estimate growth rate using their dividend information. So then you can use this dividend retention model as well as you can use this dividend growth model to estimate the growth rate if it is not given, because this dividend per share information is publicly available information. If you go to the annual report, you can look at past 10 years dividend. It is available for the PLC company. Normally they are declaring each annual report past 10 years information. So therefore these are available information. So you can apply this dividend growth model to estimate the growth rate, and also you can use this retention growth model to estimate the growth rate. So when you apply this dividend growth model, this is based on our dividend growth model. According to this, you know that when the dividends are growing at a constant rate, right? When the dividends of a company is growing at a constant rate, DN in any year, dividend in 10 years, 20 years. So likewise you can forecast. So DN is equal D0 into 1 plus growth rate into the power n. If dividends are growing at a constant growth rate, so you can forecast any dividend in the future period. So based on this formula, this is dividend growth model based formula. So then you can rearrange this formula for the growth rate. So if you simplify this for the growth rate, then dn divided by d0 is equal 1 plus growth rate into the power n. So in order to remove this n, both sides you can multiply 1 over n. So 1 over n means n square root. එකට n කියලා කියන්නේ n වල වර්ගමූලය කියන්නේ. Right? එතකොට මේ පැත්තට 1 over n දානකොට it means that square root of n. dn divided by d0 square root of n, not the normal square root. So therefore, end to end there is a trade-off here. So then you will end up with this name dn divided by d0 square root of n is equal 1 plus growth rate. So then ultimately growth rate is equal this minus 1. Right? Growth rate is equal dn divided by d0 square root of n, not the normal square root. Then from that answer you have to deduct 1. So then you will have growth rate. So this is we call dividend growth model. So that is based on this dividend growth model. By looking at the dividend per share information, you can estimate this growth. If it is not given, suppose for your research you want to estimate growth rate. Growth rate is given, and so then you can estimate. You can go to the annual report. You can collect DPS information for past 20 years, 30 years, 10 years. So then you can estimate the growth rate. If that company has established in 5 to 10 years, so this growth rate you can consider theoretically as a constant growth in dividends. ඒක තමයි theoretical basis. සාමාන්‍ය theory එක කියන්නේ company එක අවුරුදු 10ක් විතර perform කරලා තියෙනවා නම් අපිට ඒක constant profit rate එකක් විදිහට assume කරන්න පුළුවන්. In that way you can estimate that. Okay? සීතලයි උඩ. මෙයාගේ ඒක අඩු කරගන්න. අඩු නෙමෙයි temperature වැඩි කරගන්න. අත් ඒක ඔල්ලන්න ගන්න ඒක කරගෙන. And that is it. Right. So now we are given some information for a Sunshine PSC dividends for last few years. So you are provided for 5 years. 5 years DPS information. Estimate the growth rate. Dividend per share information for the Sunshine PSC for 5 years is given. So now estimate the growth rate. Five years, right? So growth rate is equal dn divided by d0 square root of n minus 1. We have 5 years DPS information. So then when you apply this model, you have to define D0, Dn. So which year is the D0? 2018. This is D0. මේක තමයි D0. D0. Then D1, D2, D3, D4. Right? The Even though you have 5 years DPS information, when you apply this, right? When you apply this model, so 5 become 4. Because first one we considered as a D0. Right. So then you can apply D0 is 1.1. It is 1.10. Dn 1.5. Square root of n. N now here 5 or 4. 0. This one is 0. 1, 2, 3, 4. 5 or 4? 4. But there first one is 0. Then 1, 2, 3, 4. Even though you have 5 years DPS information, so then n here, not 5, this is 4. Minus 1. What is the answer? Not the normal square root, right? Square root of 4. හතරේ වර්ගමූලය. සාමාන්‍ය වර්ගමූලය නෙමෙයි. මෙතන කැලේ අර shift එකත් එක්ක ගහලා ගන්න ඕන. This answer. That's why you can take this one. You can take like this. Now here, 1.5, say one some answer, right? So this answer is 1.5 divided by 1.1, say 6 answer. So then you want to have square root of 4. So then 4 shift x square so that one. So then you have to put the answer 6. That is the answer. Instead of getting on the square root of that 4, between 4, then 4 or 5 shift, and this one. It is exactly 100 one. That shift the orange color thing is done. Shift, then square root x kilometer ඒක ඊපස්සේ අපිට ආපු අවශ්‍ය කරලා දෙන්න පුළුවන් තුනක් ඉතින් දෙන්න දෙන්න පුළුවන්. So then this is the answer. And then 8.95 is correct. So shift so the answer should be 8.96. 8.95 is the answer. Correct, correct. If it is square root of 4 now, 4. If it is square root of 6 now, 6. So likewise. Have you all got this answer? 8.95? Okay. Right. So then this is based on this dividend growth model. So the next one is the retention growth model. So that one also you can apply to calculate the growth rate. As I remember, the derivation part of this one I explained under second valuation. According to this, growth rate is equal return on equity. Return on equity into retention ratio. So I will explain this one, I think, second valuation as I remember. So this formula we applied in the second valuation also. If you go back, you can see that derivation. Yes, I explained that one. So that is also you can apply to estimate the growth rate. We call this retention growth model. So this one is we call dividend growth model. So under the retention growth model, return on equity, ROE multiplied by retention ratio. So when you apply this retention growth model, certain assumptions are there again like the dividend growth model. Earning growth is constant, dividends are growing at a constant rate. So you can see dividend policy is constant. Dividend policy means retention and the payout policy is constant, and also we expect return on equity is not changing, because if all these things are, if dividend policy is constant, so then return on equity also will be constant, and also we expect no, very recently the company is not considering any new stock issue. That is also assumption that, and also we assume that company future project or the future investments are having same degrees of risk like the company average risk. So likewise, these models we are applying subject to certain assumptions, right? So in practically when you are applying these things to estimate the growth rate, so we are coming these numbers subject to these assumptions, right? You can search, you can look at the textbooks and you can see further if you need to identify this. Basically, it assumes that earnings growth, dividend policy is constant, earnings growth is constant, then return on equity is constant, and also the dividend policy is constant. So these are some assumptions related to the earnings and dividend behavior of the company. Right. Okay, so the next one is capital. So I'm not going to apply this with an example. So then this is dividend growth model. If the growth rate is not given, so you can apply dividend growth model or this retention growth model to calculate the growth rate. So the next one is capital. Yes, we discussed last, I think not the, yes, last week. So you remember the capital. According to the capital asset pricing model, investors require rate of return based on which risk? Capital, we calculate investor required rate of return based on which part of risk? Today the quiz is on risk and return. So what is the relevant risk when you apply the capital? So what is the relevant risk? Total risk can be divided into two, systematic and non-systematic. So this unsystematic risk, is it a problem to the investor? No, because by having a diversified portfolio, you can terminate it, you can avoid it. So the matter is systematic risk. So based on the systematic risk, all these portfolio management theories, portfolio related models have developed. So the capital also based on the systematic risk. So related to the systematic risk, this captain is calculating investor required rate of return. So the beta coefficient is the variable. So I think remember beta is we are calculating related to the well diversified portfolio. We call it market portfolio. So market portfolio is the portfolio of all risky assets. In our context, our stock market is our market portfolio. We have 298 around assets, listed companies. They are risky, right? So related to that market portfolio, we are calculating beta for shopper flag, beta for the loyalty, beta for the loyalty. So likewise, we are calculating beta coefficient. Related to this, we are diversified market portfolio. In the market portfolio, there is no unsystematic risk. So therefore, theoretically, systematic risk coefficient for the market portfolio always equal to 1. When beta is equal to more than 1, it implies what? If for a particular company, if beta is 1.5, what you can say about the systematic risk of that company? If beta is 1.5, beta is the measurements of the systematic risk. If beta is 1.5, what implies it? High systematic risk. Because related to the market portfolio, if market return decreased by a particular time because of the market return in the matter economy came down. The economy down economic impact in the market portfolio return or share price index return 1% drop for this particular company, profit is 1.5 more than that. So that is high systematic risk. හැබැයි අනිත් පැත්තට market එක හොඳට perform කරන වෙලේක මේ company එක outperforming. Because when the market is earning 1% return, this company is earning 1.5. This is outperforming company at that time. But downside of that is it is going to the worst. So therefore this is high risk, high systematic. So if the beta coefficient is less than 1, say 0.5, means low systematic risk. So likewise related to the beta coefficient, you can calculate risk premium. So according to our theoretical explanation, required rate of return for an investor is equal risk-free rate of return plus some risk premium. Risk premium for the time value of money. So you can identify the appropriate risk premium based on the treasury bills, treasury bonds, rate of return. So then this risk premium is the matter. How to determine the appropriate risk premium related to the systematic risk. So our systematic risk risk premium here. So you should be able to calculate it. For that we are using a model like this is a very primary model. So that is CAPM based calculation. So according to the CAPM, required rate of return is equal risk-free rate of return plus risk premium. You can calculate market risk premium. So market risk premium is equal market return minus risk-free rate. Even up market risk premium. So this is the premium given per systematic risk in the market. විධිමත් අවදානම එක ඒකකයක් වෙනුවෙන් කෙවල ප්‍රීමියම් එක තමයි මේ. The difference between market return and the risk free rate. මේක market return suppose you are doing research. The market return එක කොහොමද calculate කරන්නේ? Based on all share price index. So that is the market performance indicator. So based on the all share price index, all share total return index, so you can estimate this market return. Risk-free rate based on the treasury bonds and the treasury bills. So that difference we call market risk premium. So market risk premium multiplied by the relevant beta of your company. So we call it as the risk premium. That is the risk premium. So this is the one. So investor required rate of return you can calculate based on the capital. So this investor required rate of return is equal to cost of equity. This is investor required rate of return from the company perspective, that is cost of the company. The make investors like rate of return එක company එක මේක දෙන්න ඕන. නැත්නම් අපේ investors ලා වැළඳෙන්නේ නැහැ. So therefore investor required rate of return from the company perspective, it is its cost of equity. Then we calculate the cost of capital, not the investor required rate of return. So the capital you can use to determine that. So that investor required rate of return from the company perspective, it is cost to the cost of equity. So this is something about the capital. I think I discussed that in the previously also. So some example is given. Still, if you have any questions, you can ask, right? Don't worry. JKH, John Keats. Beta is 0.92. 0.92. And yield on London Treasury bond 6%. And market risk premium. So you are provided here market risk premium 4.5%. What is the cost of equity for the John Keats? Cost of equity for the John Keats. So you can apply the numbers. Tell me how much the market return. That information, market return. Market return is how much? Market risk premium is given. Difference between the market return and the risk-free rate එක තමයි දීලා තියෙන්නේ. Market risk premium. So the market return is how much? Risk-free rate එකක් තියෙනවා. It is 6%. In a market return is 10. Market return is how much? මේ දෙකේ එකතුව නේද? 6 4 එකතුව. The market risk premium එක දීලා තියෙනවා. You are provided here market risk premium. Here the 4.5. Market risk premium is equal market return minus risk-free rate. එතකොට 4.5 is equal market return එක දීලා නැහැ. Risk-free rate එක දීලා තියෙනවා 100ට 6. So then market return 10.5. 10.5. How much the cost of equity? What is the answer? Cost of equity or the cost of equity? Internal cost of equity as remaining still is equal risk-free rate of return 6% plus beta 0.92 less than 1. So it means that compared to the market, systematic risk of this John Keats PLC is low because it is less than 1. The market compared to market, systematic risk is low into market risk premium 4.5. This is the answer. it 10.12? Okay, now, did you get this answer? 1 more, take 10.1. Right. Now do this one. Suppose common stock in the alpha company has beta 1.2, market risk premium 8% and the risk-free rate 6%. Alpha's last dividend was 2 rupees per share and dividend expected to grow at the 8% indefinitely. Stock currently sells for 30 rupees. What is the alpha's cost of equity capital based on CAPM as well as dividend growth model? So you can apply both now here to calculate because with the given information, you can apply both CAPM and dividend growth model. Calculate the answer. Finish. Finish. If you have any question, you can ask, right? So you can apply both. Let's say the given information. So beta, company has beta 1.2, beta is 1.2, and market risk premium is given is 8%, and risk-free rate also there. Risk-free rate of return 6%. In addition to the dividend growth model, dividend was last dividend, so that means D0, 2 rupees per share. Dividend is expected to grow at a constant rate 8%, so constant growth rate of dividend 8% for indefinitely. Currently sell for 30 rupees, so price we consider as the value here, 30 rupees is given, and that's all. So based on the capital and dividend growth model, so you have to estimate cost of equity. So according to the dividend growth model is equal next period dividend divided by price value plus constant growth rate. According to the capital, cost of equity is equal risk-free rate of return plus beta coefficient into market return minus risk-free rate of return. So D0 is there, then we can work out D1. D2 should increase by 8% from here. Price 30, growth rate 8. So this is the answer with the dividend growth model. If you apply the capital, answer is delay. You missed out. Right, beta risk-free rate of return 6%, beta is 1.2, and you are provided here market risk premium. So then simply you can apply here market risk premium 8%. So calculate the answer. Any question? So it's approximate 15.6 based on capital and 15.2 with the dividend growth model. Now suppose in the exam with a question, right? For the exam paper, you are given cost of capital estimation question. So you are provided information to apply both capital and the dividend growth model. So either you can use this or that. When you are calculating the answer, you can see maybe some might have different, for sure it will have a different answer. So at that time, in the paper, it should clearly mention that you go with the capital or you go with the dividend, so that if that information is there, you can go with that one. In case it is not there, so you can take average of these two as the cost of equity. Some textbooks are using like this, but for your exam, I am not giving that kind of confusion for you. Exactly, I will mention you have to apply this model to estimate that one. But in case So then different methods are there for cost of equity calculation. So we are using here different methods again because of that uncertainty about the expected dividends of the cost of equity. In the valuation also we realize that calculating the value is difficult because expected dividend is very uncertain. That there is no maturity. Right? So there is no fixed dividend. So therefore there are certain uncertainties in the cost of equity. So therefore different methods, different models are applied here also to estimate the cost of equity. So some textbooks what they are doing, they calculate cost of equity based on capital, based on dividend cost model, based on quantity cost estimate method, based on realized yield method, another method is there. So then they take the average. That way they can proceed. But anyway for you will not get that much problem. But anyway, that is the way. Right. Now let's go to this one. Okay, with the capital and the dividend growth model. If there is a flotation cost, suppose that company is issuing new shares, equity shares, new issue. If that, so what you have to do with the new stock issue, then cost of external equity or cost of issuing new shares, you can estimate using dividend growth model. Using dividend growth model. So same model here. The only thing you can see price we adjusted for the flotation cost. So we are taking here net price after the issuing cost, after the flotation cost. So therefore price we have to adjust it for the flotation cost. So that is price multiplied by 1 minus flotation cost. So normally this flotation cost provided as a percentage. So then you can calculate net price after considering the flotation cost. So that is you have to apply here if there is a new stock issue, then cost of external liquidity KE. We can apply using this dividend growth model only with that difference. What is the flotation cost? Issuing cost. When a company is issuing new shares, certain costs are there. They have to pay for the investment banks, they have to pay for the underwriters, they have to pay certain documentation charges, some certain things are there related to the new issuers. So then all these things be included in this flotation cost. So that is we have adjusted for the price. So then we consider net price here after the flotation cost. So then you have to apply dividend growth model to estimate the cost of external equity or cost of new common when the company is issuing new shares. That's all for you to related to that cost of external equity calculation. There are some more discussion, but anyway, I will stop that point because otherwise, no anymore. So, but anyway, you can apply this dividend growth model with that adjustment when there is an external equity issue. Right? So, normally this flotation cost present as a percentage, so you can adjust it to the price. Look at this example, market price of the share of the common stock, same example like our earlier. Market price is 30 rupees. If additional shares are issued, there is a flotation cost 12%. If there is additional new stock issue, then they have to bear flotation cost of 12%. So then D0 is 4 rupees, growth rate is 8%. So what is the cost of new common equity or cost of external equity? So now way to apply capital. So we have to go with the dividend growth model. So then cost of new equity KE is equal E1 4 into 8. 4 should increase by 80%. Divide by price 30, but you have to consider after flotation cost price. Flotation cost is 12%. So 1 minus 12% plus float rate. So then you can have the answer here. It was 22.4 without flotation cost. The same example, right? When there is a flotation cost, now what is your answer? It is 24.36. Now you can see cost of external liquidity greater than the cost of internal liquidity. Because of what? Same question we previously got the cost of internal liquidity, the dividend growth. The answer was 22 something. Now, when a company is issuing additional shares with a flotation cost of 12%, now cost is 24.36. Now, for the exam, if I ask a question, what is the reason that cost of external liquidity is greater than the cost of internal liquidity? What is the reason? Yes? Flotation cost. Because of the certain expenditure, certain costs related to the new stock issues. But internal liquidity means retained earnings. There is no that cost. But when a company is issuing new shares, they have to bear underwriter's charges, some certain things. So therefore, that is the reason. So therefore, you can see cost is increasing. 24.36. So that is increasing. Right. So the last method to calculate the cost of equity is the bond yield plus risk premium method. This is very simple. Actually, this one you can apply it to the unlisted companies, private companies. So CAPM-like model you can apply if that company is listed because beta coefficient you can calculate related to the market portfolio, connecting with the market portfolio. But if it is an unlisted company, private company, small SME, so then how to determine the cost of equity? So that is you can apply this bond yield plus risk premium method. You remember when it comes to the risk factor, when we consider the risk, if you take the debt capital providers and the equity capital providers, even in the SME, there is a debt capital providers and the equity providers. Who is taking high risk? Which part is taking high risk? Equity holders or equity capital providers. So therefore, if they are taking high risk, they should have something more than the debt capital providers. That is the logic. On that base, so the equity shareholders' required rate of return should be greater than the required rate of return of the debt capital or the debt holders. So therefore, based on that logic, this bond yield plus risk premium method is calculated. Cost of equity is equal yield on the long-term bonds plus some risk premium. So this is the required rate of return for the debt capital provider, yield on the long-term bonds, so say YTM, or the required rate of return of the equity share bond debt capital providers. plus some risk premium. So this risk premium for what? Because these equity shareholders are bearing the additional risk in a company. They are the ultimate risk takers. They are the residual owners. So therefore, for that, they should have some extra premium than the bond yield, than the bondholders with rate of return. So therefore, we are adding this risk premium into the cost of debt or the YTM. So that is simply simple method. So that we call bond yield plus risk premium method. But remember, this risk premium is not like the risk premium we estimate with the CAPM. CAPM risk premium is equal market return minus risk-free rate into beta. So this is the risk premium in the CAPM. But this risk premium is not this market risk premium, CAPM based risk premium. Here, risk premium means in a listed companies, in a listed company you can estimate cost of debt, cost of equity. So that difference between the cost of debt and the cost of equity we add here as the extra premium. This is especially we apply for the unlisted companies. Then this is a SME. We have a venture company. So that is suppose we are in the hotel industry. If you have a market portfolio, hotel industry, there is a hotel industry. So then for a hotel industry, in a listed company, you can identify cost of debt and also the cost of equity. So that difference in the industry, in the hotel industry, we consider here as a extra risk premium. For this bond yield, we add some that extra premium. On that base, we estimate the cost of equity. This is very simple, undeveloped method, but still you can apply for the unlisted companies. For the listed company, you can go with the capital. You can go with the dividend growth model. And also, if suppose a company, there is no any dividends. Company with dividend given there. So then how to estimate? So you can go with this bond yield plus risk premium method. Right? So as equity investors bear high risk than the bondholders, they expect high returns than those bondholders. So they are used by the company which are not publicly traded, which are not listed, unlisted. This risk premium is not like the capital market risk premium. This is based on the market, based on the market information. This is not a listed company. This is very small venture, private company. So this risk premium is different from here. So here risk premium means different between the recurrent rate of return on the debt and the recurrent rate of return on the equity. So that difference we consider as the extra premium for this type of companies. The risk premium in the bond yield plus risk premium approach is the difference between cost of equity and cost of debt of the company. So that is very simple method. For small companies, they can apply kind of things to estimate the cost of equity. Fine. So the next one is, now I think we discussed cost of component capital calculation. So you learn how to determine cost of debt. When it is a bank loan, when it is a bond, like this. And also the cost of preference shares. If it is redeemable and unredeemable, so likewise. And cost of equity, using basically three methods. What we call CAPM, dividend growth model, and this bond yield plus risk premium. Now we are going to estimate overall cost of capital, WACC. Considering all this component cost of capital, so now we are going to estimate WACC and also marginal cost of capital. Do we need any 10 minutes slide break? Samahana bandana breakfast you need that? About 10 minutes. If you need need, I can, otherwise, because I can continue this one with the MCC and the things. So that I want to continue that one. So if you need, you can have a 10 minutes break. If you don't, if you are not need, I can continue. But when it's 10 minutes maximum. Within 10 minutes. Now time is 9:48. So around 10, you will be back. Palagi submission adane dala tibbima මම ඒක අගරුම අතර දැම්මා. මේ ඒ උපරිම මොකද ඒකට දැන් next week එකේ lectures මෙහෙන්නම් කියන්නේ තියනවා කියලා. physical. එයාලත් පොඩි විෂය එකක් තව අරගන්න තියෙනවා සමහරට ऑनलाइन करायचं जाणलं आहे वाला प्रोडक्ट पुश करो समय के लेक्चर्स कैंसिल हो करना था सकते किसने है तो तो आगे तक तेरे का करना लो इमीडिएटली तो अपने प्रेजेंटेशन करना पड़ेगा तो अगर वाला ये टाइम में सबमिट करें normalized market අපිට isolated දැන් අපේ market එකේ split එක extend එක දෙන්න පුළුවන් මොකක් හරි impact එකක් ගන්න අපිට තේරුම් ගන්න තියෙන market එකේ ප්‍රශ්නයක්. අර ඒ වගේ මේ connection එක තමයි උතනදී බලන්නේ. content එක මගෙන් අහන්න. really decide කරන්න තමයි දෙන්නේ. ඔයාලට ඒ aspect එකෙන් මොන හරි motivation එකක් කරන්න කියන එක තමයි මම කියන්නේ. geopolitical event එකක් මොකේද අපි markets වලට බලපාන්නේ කියලා.
Clearly industries and globally benefiting
content wise introduction to the definition relevant geopolitical events explanation relevant financial market it was an overview it was key factors affecting this market political instability as a role of government we have been market stability market control government involvement it was a events කොහොමද අපේ future අපේ environment එකට institutions වලට අපේ investors ලාට ඒක negative කොහොමද navigate කරන්නේ impact වෙන්නේ කොහොමද ඊට පස්සේ ඔයාලා මොන හරි differences කරලා තියෙනවා මේ මම නිකන් කියනවා තමයි content එක. ඒතකොට මේ content එකම කියන මම බලාපොරොත්තු වෙන්නේ නැහැ. ඔයාලට තියෙන topic එක තමයි geopolitical events on global financial market. ඒක global financial markets වල isolated events වලින් ඒක කරන්නේ මේ දැන් උදාහරණයක් ඒ පයිවට් එකත් geopolitical event එකක්. ඒක අපේ මාර්කට්ස් වල global financial market එක අපේ මාර්කට් එක කරන්නේ මේ global. ඒක ආදරෙන් මාර්කට් එක ස්ට්‍රෝං මේ කලින් වල ඉන්දියා චීන US ඒ වගේ අර ඉන්නෝල ලීඩර්ස් ලා දැන් ඔය කට්ටිය අතර ඊට කොම්පිටිෂන් එකක් තියෙනවා. චීන හැමදේම ඉන්දියා බලන්නේ අපේ ප්‍රොජෙක්ට් එක චීනෙට දෙනකොට එයා ගන්න. ඒකේ ජියෝපොලිටිකල් කොන්ෆ්ලික්ට්ස් තමයි තියෙන්නේ. ඒ වගේ අර බ්‍රෝඩ්ලි තමයි මම නිකන් ඔයාලා අනුගමනය මේ ටොපික් එක කියවලා මේ ආශ්‍රිතව තියෙන පොඩ්ඩක් දැනුමක් කරගෙන ඒවා ප්‍රසන්ට් කරන්න ඕනේ කියන එක තමයි මගේ අදහස. දැන් ඔයාලා මේ ස්පෙක්ට් එක කියවන්නත් නැහැ. දැන් අපි ගත්තොත් එහෙම මේ ස්ටයිල් එක ගන්න එක ඒක පැත්තට ඩිපෙන්ඩ් කරනවා. ඒක කිසිම කෙනෙකුට කන්ෆර්ම් කරන්න බෑ. මේක ලොකු ජොබ් ඔපර්චුනිටි එකක්. වාලට ඒක හරියට ඇනලයිස් කරන්න ඕනේ. මොකද අපේ මේ ග්ලෝබල් ෆයිනෑන්ෂියල් මාකට් එකට ඉම්පැක්ට් වෙනවා. ඒකෙන් වඩා සිවියර්ලි එෆෙක්ට් වෙන කන්ට්‍රීස් මොනවාද? Developing nations වලද developed nations වලට ඒකට බලපාන්නේ නැහැ. ඒක countries වලට බලපානවා. දැන් කියන්නේ ඇත්තටම දැන් අපි ඉස්රායල් ගත්තාම අපි ඉම්පෝර්ට් එකක් එක්ස්පෝර්ට් එකක්. ඒ ඉන්කම් වගේ දේවල් තියෙනවා. ඒක අපේ මාර්කට් ඩොලර්ස් එකේ ගන්නවා. ඩොලර්ස් වලට බලපානවා. ඒ වගේම දැන් අපි හිතුවොත් දැන් අපේ මාර්කට් එකේ සමහර කෙනෙක් අපේ ඉම්පෝර්ට් හාවල් එක ගත්තම ඒක ඇවිල්ලා අපේ මොන ලෝකේ කතා කරන මේ ජියෝපොලිටිකල් මේ ප්‍රොපර්ටි එක. මොකක් අල්ලගන්න කීකෙනෙක් ෆයිට් කරනවා. ඒ වගේ මේකත් අපි අපිට තියෙන ලොකු මේකක් තමයි මේ විප්ලවනේ ස්වභාවය බලන්න තියෙන්නේ. ඒක උදාහරණ කතා කරගෙන එතන මට මම ඇසෙස් කරන්නේ ඔයාලගේ ඇස්පෙක්ට් එක පිළිබඳව අපි කියනවා. ඒතර ඔයාලා යම්කිසි දෙයක් මේකේ ඔයාලා ලක්තද ඒක ප්‍රසන්ට් කරන්නේ. ඒ ඇස්පෙක්ට් එක මට බලන්න ඕනේ. ඒ ඔයාලා අපි මේ ෆයිනෑන්ස් එකේ නෙමෙයි මේක ෆයිනෑන්ස් එකේ නම් ඔයාලා නිකන් මේවා කියවන්නේ දැන් ජියෝපොලිටිකල් කියන එක සමහරවිට ඉගෙන ගන්න නැත්නම් මේකත් එක්ක වෙනවා. ඒක එකක් කියන්නේ මොකක්ද? ඒක කොහොමද බලන්නේ? මේ වීඩියෝ එකක් ගන්නකොට මෙන්න මේ වගේ කන්ටෙන්ට්ස් එකක් දෙනවා. ඒවා මම කියන්නේ ඒවා යූස් කරන්න. ඒවා කියවන්න. ඒ වගේ නොලෙජ් එක අරගෙන ඔයාලා යමක් අරගෙන මෙතන තියවල ඒක මේ තව කෙනෙකුට ෂෙයා කරන්න පුළුවන් වෙනවා. ඒක ඉන්ටර්නැට් කරගෙන තියෙනකොට එයා කියනවා ඉවෙන්ට් එක කරනවා ඔයාලා දන්නවා කියලා. ඒක තමයි මම ඇසෙස් කරන්නේ. ඒක මේ ඔයාලා ලොකු ස්ට්‍රෙස් එකක් කරගෙන ඉන්නේ. ඒත් මට තේරෙනවා දැන් ඔයාලා යම් කිසි ප්‍රමාණයක් මේක ඔයාලා කියන ඔක්කොම ප්‍රසන්ට් කරන්න බෑ. මේක ලොකු මේ කතන්දරයක්. ඒතකොට ඒ ඔක්කොම නෙමෙයි ඔයාලා ඉවෙන්ට්ස් දෙක තුනක් අරගෙන ඒ ඉවෙන්ට්ස් වල ඉම්පැක්ට් එක කොහොමද මේ අපේ දැන් ග්ලෝබල් ෆයිනෑන්ෂියල් මාකට් වල මෙතන IMF කියනවා වර්ල්ඩ් බැංක් කියනවා ඒ වගේ මාකට් එකේ ඉන්න ලෝකේ ඉන්න බලවතුන්ට බලපාන ආකාරයෙන් අපි බලන්න ඕනේ. ඒක බලවතුන්ට බලපානකොට අපිට බලපානවා තමයි. ඒකෙන් වෙනවා. දැන් පාකිස්තානයේ මේ ළඟදී බැංක්‍රප්ට්. අපි හිතුවත් නැහැ ඒ රට එළිවෙන්නේ. අපිට වඩා ප්‍රශ්නාවයකට කියන්නේ. මතකනේ අර පාකිස්තානේ නේද? බංග්ලාදේශ. අපි හිතුවත් නැහැ කවදාවත් බංග්ලාදේශෙ එන්නේ කියලා. අපේ හොඳයි අරගෙන අපි යම්කිසි තැනක ඒක නවත්තගත්තා. ඒ අරගෙන බලන්න. ඒකත් ජියෝපොලිටිකල් ඉවෙන්ට් එකක්. ඒකත් එක්ක දැන් අපි ඒ කාලේ බංග්ලාදේශ ගියා අපේ මේ රිසර්ච් ප්‍රසන්ට් කරන්නේ. අපි ඒකේ අපේ මේ ඇකඩමික් මේකක් තිබිච්ච කල්පේ. මේ ඒතකොට ඒක මේ බලන්න ඒක ඒ ඔක්කොම ඒවා කියන ජියෝපොලිටිකල් තමයි. කවුද මෙම්බර්ස් තුන්දෙනා ඉන්නේ? පස්වෙනි ඔය මොකක්ද කරන්නේ? ඉතින් මේ AI යූස් කරන්න වන්දලට මේවා හදන්න බෑනේ AI වගේ යූස් කරන්න. හැබැයි දාන්න මොනවද වල රෙෆරන්සස් දැම්මේ. ඔයාලා AI යූස් කරා නම් ඒ රෙෆරන්සස් එක මට තියෙනවා. ඒක මම දන්නවා ඔයාලා මේකෙන් තමයි මේක සෝස් කරලා තියෙන්නේ කියලා. හැබැයි මම ටිකක් වේගවත් ඔයාලා මේක තනිකර බොරුවක් තියෙනවා ඔයාලා කියවන නැහැ කියලා ඔයාලා බෙදා ගන්න. ඔයාලා ඉස්සෙල්ලාම ස්ට්‍රක්චර් කරගන්න. කෙනෙක් ඩිෆයින් කරන්නේ මොකක්ද ජියෝපොලිටිකල් එන්වයරන්මන්ට් එකක් කියලා කියන්නේ. ඒක කවුරුද හිතන්නේ? ඊට පස්සේ අපිට දැන් මේ වැය කාලවල ලකිනකොට මේ වගේ ඉන්සිඩන්ට්ස් මොනවද ඉවෙන්ට්ස් මොනවද තුනක් ගන්න. අරගෙන ඒ තුන තුන දෙනා කතා කරනවා. ඒක කොහොමද මේ රටවල බලන්නේ කොල්ලේ කන්ට්‍රීස් වල ඉමීඩියට් ඉම්පැක්ට් කන්ට්‍රීස් වලද ඒක ඒ කන්ට්‍රීස් වල අපේ ලංකාවට කන්ට්‍රීස් වල වෙනස් තියෙනවද ඒ වගේ එක්ස්ප්ලෝර් කරනවා. දැන් අද තමයි පටන් ගන්නේ වගේ. දැන් ඔයාලට මම ඔය කයි මේ ක්ලික් කරලා දානවා නේද සොෆ්ට් කොපි එක සබ්මිට් කරන්න. So then we are going to estimate weighted average cost of capital. So weighted average cost of capital means very simple thing. If you know the component cost of capital, if you know the cost of debt, cost of preferred stock, and the cost of equity, and also the weights on each capital, right? Weights on each capital. So simply suppose this is the capital structure of the ABC company, right? Say this is ABC company, their capital structure is like this. 40% they 40% of their total fund requirement they have financed with the debt capital. Say 60% of their funds, say 50% of their funds requirement, suppose they have financed with the equity capital. Then another 10% in their capital structure consists preferred stock. So this is the capital structure. This is how this particular company has financed their total fund requirement, total capital requirement. So then you need to calculate the overall weighted average cost of capital of the company. So in order to calculate this, you should know what is the cost of debt and also what is the cost of preferred shares and cost of equity. So, and also you should know weights. This weight should be based on market value. Right? So normally you can calculate these weightages or the weights based on the balance sheet or the historical value. Weight on the book value of the debt capital, book value on the preferred shares, and the nominal value of the equity capital. So likewise, based on the historical cost, also you can calculate these weights. But remember, this cost of capital is should be a current, and also it should be a very reasonable number. Because based on this one, our next lecture capital budgeting, we are going to evaluate our investment project. This is the benchmark. This is our minimum required rate of return. So therefore, this should be based on reason or the very, it should reflect the current investors' required rate of return. It should reflect the current market expectation. So therefore, when you estimate these weightages in the capital structure should be based on the market value. Right? Based on the market value, this weight on debt, weight on equity, weight on preferred shares should have the value. So if you know these things, then you can calculate weighted average cost of capital or the overall cost of capital. So that is our next discussion. Compute the cost of each sources of capital. We done it. Just finish. Then determine the percentage of each source of capital in the capital structure. Percentage on debt, percentage on equity, percentage of the preferred shares, weight based on market value. Remember, always it should be based on the market value. With the calculations you can visualize. Then you can calculate weighted average cost of capital using this formula. Very simple this. So weighted average cost of capital is equal simply WACC, or weighted average cost of capital is equal cost of debt. It should be after tax, because it should be a true cost of debt. After adjusting for the tax shield, cost of debt, after tax cost of debt into weight on debt capital plus cost of preferred shares, weight on the preferred shares plus cost of equity, say KE or KS, and weight on equity capital. So this is the weighted average cost of capital. This is the VAT. So you should know component cost of capital and weightages in the capital structure. So then we can calculate weighted average cost of capital using this formula. Weighted average. Weight on that relevant cost plus next. So that is weighted average. Right. Now suppose, let's discuss this one with example. ABC PLC estimate the following cost. Sources of capital and the cost provided. Bonds. Bonds mean part of debt. So they are bonds. So the cost of bonds 11%. Cost related to the preferred stock 13%. Under the equity or the common stock, two categories declared. Cost of retained earnings, internal equity, new stock issue 16% and 17%. So you know that difference is coming because of the issuing cost. Tax rate is 40%. So now you provided this component cost of capital. In order to calculate the VAT, weighted average cost of capital, you should know capital structure or the weight on equity, weight on debt, weight on the preference shares. Suppose their capital structure, assume the total capital requirement of this company, their total capital requirement 100,000 and their desired capital structure or the optimal capital structure that is given 40% debt, for 20% preferred stock and 40% equity. So their desired capital structure is like this: 40% from the debt capital, another 40% from the equity, 20% from the preference shares. This is their optimal or the desired capital structure. Right. First, using the retained earnings. Normally, when you calculating the VAT, so first we have to consider internal equity. So that is retained earnings. If using retained earnings to finance the common stock portion, 40% equity, 40%. Common stock portion of the capital structure. So what is the weighted average cost of capital? Well, so these are the costs. So you have to consider this retained earnings or the internal equity first. Considering using retained earnings first, calculate ABC weighted average cost of capital. So you can calculate weighted average cost of capital. So you can do it back for the using retained earnings is equal. Cost of debt is 11%. So that is normally if tax rate is provided separately, right? If tax rate is given in the question separately, it means that this 11% KD cost of debt is before tax, right? It is before tax. So you have to adjust it for the tax sheet, right? If Galle this is after tax cost of debt here, so you can consider it. But normally tax rate provided as extra information, so it means that this debt cost is before tax basis. Cost of debt is bonds 11%. So this is before tax. So you have to adjust it for the tax sheet. You know how to do that. We discussed earlier. So we have to multiply by 1 minus tax rate. Weight on debt capital 40% plus. Cost of preference shares 13%. No need to do any adjustment. You can take it as it is. Weight on the preferred stock capital is 20% plus cost of equity. So we are considering first this internal part to finance the equity portion. So therefore, first we have to consider the internal equity, the cost relevant for that 16%. So 16% into 40%. So then you will get WACC, weighted average cost of capital, for this ABC using retained earnings is how much? Is there a mistake? Is there a mistake? Huh? Doubt it. What is it?
This was 13%. We are again putting in 13 into 0.2 because both are percentage.
I didn't get it.
Both are percentage. So why we are like converting one into decimal and other one into decimal?
So first we put here as 11%, right? Here I put this. This is 40% as a 0.4. And also this tax rate is a 0.4. So then answer again I am not required to multiply it by 100. So like 100 so if you put this also as a 0.11, the answer you have to multiply by 100. That fiscal return is no issue at all. So when you are doing that, just take the return as number 11%. So then if you put one number here as a 0.4 as a decimal, so then your answer you are coming is that reason. But anyway, if you put all this on a decimal basis even, the answer you will get. But you have to multiply it by 100 to convert into the percentage. What is the answer? What is the back? 11 point? 11 point? Yes, your answer is, yes, I think it is correct. 11.64. This is the weighted average cost of capital. 11.64. So this is this ABC PLC company's minimum required rate of return that company should secure from their investment. Minimum, right? Minimum means from the investment, if suppose now this company has an investment, right? If its IRR, this investment generated rate of return, say 11.64. Are you accepting this investment? Our next lecture, capital budget. Are you accepting this? This is the minimum. Now, minimum is secured. So, can you accept this? Yes or no? Make a minimum, so minimum is there. Can we accept? Yes, then. Because minimum is there. So that is why I told this is the minimum. Have I minimum accept shareholders maximum? With the minimum you can cover cost of debt, cost of equity, cost of preference shares. But no any addition value from this investment. You can cover minimum means, so at least you should have this one. This is the cost of capital, weighted average cost of capital. From our investment, you should at least this should earn, at least this. Minimum can make a thin note. In order to have some value, in order to create some return to the shareholders, you have to earn more than that. More than 11.64. Right? So that is the meaning. So make a Galle, you can survive, no problem. But no value creation. No growth of the company. The mayor projects company will growth the company. No go. So in the long run, that will be a problem. So this is why we call minimum requirement of it. Okay? Right. Now the next point is, are you okay with this one? Right. Then I think we have to go to the MCC and the breakpoints. On that, I think that is finish the cost of capital. All right. So let's do this example as a practice. This is from your tutorial, I think. Using the following cost of capital information of the NIDA PLC, calculate the weighted average cost of capital. So you are provided capital structure related information for this NIDA PLC. Tax rate is given, market value is given. Market value of the debt, preference shares, and the equity is given. Estimate the WACC. Estimate the weighted average cost of capital. So you have to estimate this weighted average cost of capital. Cost of components are given. In order to estimate this WACC, you should know weight on debt capital, weight on preference shares, weight on debt, weight on preference shares, and weight on equity. It is not given. So total capital information is given. So how to estimate the weights? So their total capital is 2 million. So the total capital requirement is 2 million at the moment. So they have financed it for 600,000 from the debt, 400 from the preference shares, 1 million from the equity. So then you can estimate pay market value of the debt, market value of the equity, and the market value of the preference shares is given. So based on the market value, normally we estimate the weight. So then you can estimate the weight, how much the weight of the debt capital. So weight on the debt capital is equal 600,000 divided by 2 million. 2 million है तो the weight on the preference shares is equal 400 is financed with the preference shares. Total capital is 2 million. So this is the weight. So the cost of equity 1 million. So that means 50%. 50% from the equity capital. So then how much the weight on the debt? 30. Weight on the debt? 30%? 30%? This is 20%. So these are the weights, right? Now you can estimate the VAT. So weighted average cost of capital back for the AB's NIDA PLC is equal cost of debt given 19%, but this is before tax basis. So you have to multiply by tax to get the after tax cost of debt. So based on the debt capital, 30. Then after tax cost of debt again. Then preference share cost 15%, weight on it 20 plus cost of equity 28%, weight 50. So you can see here cost of components are given. So you can calculate weighted average cost of capital like this. What is now? This is from your tubes section, from your tubes. What is the answer? 20, 20.4. So now we are going to the marginal cost of capital. So here, time to time, I mention this thing again. Actually, in this slide also it is there. Weighted average cost of capital is the discount rate when we compute in NPV with the average risk. So in our capital budgeting next lecture, we are going to calculate net present value. So when we are calculating this NPV, our discount rate is the value. So we use this cost of capital as the discount factor. And also, when estimating the IRR, IRR is the project internally generated rate of return. So this IRR you can compare with the cost of capital to decide whether we accept or not this particular project. So therefore, we consider this back as the hurdle rate benchmark in conjunction with the IRR. So normally this WACC is very realistic because the weights are based on the market value and the cost of debt, cost of equity, cost of preference shares, we have estimated based on the investors' required rate of return. Right? Based on the investors' required rate of return and also after tax, after considering the tax sheet. So therefore this WACC is very realistic number. So without knowing this number, suppose how finance manager take decision, how to analyze the investment. So this is very important number. This weighted average cost of capital, is it a constant number for a long period? Can be a fixed number? No, it is changing. When the cost of debt is changing in the market, so that is changing. When a company has to issue new shares with the higher underwriting charges, Cost of equity is changing, so weighted average cost of capital is changing. So therefore, this WACC is not a static number. It is dynamic. It is changing with the market and with the investor expectation. Right? So therefore, now next we are going to estimate this marginal cost of capital, or we call MCC. So that is what. Now in this our example, it's ABC company. Let's discuss MCC relating to that. In this ABC company, total capital requirement was 100,000. Their total capital requirement was 100,000. So this 100,000 they have financed using 40% debt, 40% equity, 20% preference shares. So this is their capital structure. It's not changing. If it is an optimal capital structure, so they may maintain this capital structure for a long period. Right. So then your answer was there 11.64. 11.64. So they are like weighted average cost of capital using retained earnings. Using retained earnings, it was 11.64. And also, let's have these numbers also in your mind. It was provided cost of debt as 11%, cost of preference shares as 13%, cost of internal equity, retained earnings 16%, and cost of external equity, new stock issue 17%. So now we have estimated this weighted average cost of capital using retained earnings. Retained earnings. Now, if this company increased their total capital requirement, suppose from 100,000 to 100,001 rupee, so they have to use another source of capital. So then that cost is changed. Right? So up to 100,000, this is their total capital requirement. At the moment, they are sufficient 100,000. Now assume that they have some investment outside, so they need some extra money. They have to raise the capital. So if they are raising capital from 100,000 to 200,000, so additional 100,000 they have to raise. When this additional 100,000 they are raising, so some component cost of capital can be changed. Say they might have to issue shares, they might have to borrow at the new interest rate. Some component cost of capital is changed. I clear that? Huh? So what is the marginal cost of capital? Marginal cost of capital is cost of raising new capital. Simply weighted average cost of capital of the next rupee of capital raised, we call as the marginal cost of capital, MCC. Marginal cost of capital. Now, can anyone calculate me? Suppose you are given the available retained earnings of this company 40,000. So this is the definition of the MCC. So simply MCC means when now here total capital up to 100,000 in Dakwa. This is the cost of capital. So this company, if they want to increase their total capital from 100,000 to 150, so additional how much they have to raise? 50,000. For that 50,000, there is a cost. There is a cost. So then this cost of debt might differ. So the bank will say, if you are raising more than this, your cost interest rate is 12%. So sometimes the retained earnings is not sufficient. Now this company has to issue new shares to maintain this capital structure, right? So that is happening, ever happening in the WACC. Weighted average cost of capital is ever changing. When the component cost of capital is changing, WACC is changing. If the cost component එක පිළිවෙල වෙනස් වෙනකොට WACC එක වෙනස් වෙනවා. එතන මේ WACC cost component cost of capital එක වෙනස් වෙනවා හැම break point එකකම. Right? Have a break point there, you can identify MCC, marginal cost of capital. Let's see. Right, so this is the MCC. So simply what is MCC? ABC PLC's weighted average cost will change if one component cost of capital will change. That is correct. So what is WACC? What is MCC? Is the WACC. It is the weighted average cost of capital of the next rupee of capital raised, we call marginal cost of capital. With the example, you may realize if you are unable to capture this one, just forget about. I will explain with the example. So that is the MCC. It is the weighted average cost of capital for the next rupee of capital is raised. Now suppose this ABC PLC has retained earnings only 15,000. 40,000. This retained earnings available for this company, retained earnings 40,000. Right? 40,000. So up to what capital level this 40,000 is sufficient? Then we allocate retained earnings in half. So now suppose when the company is increasing their total capital at a certain point, at a particular point, this company has to issue new shares because this 40,000 is over. Internal equity is over. So then, in order to maintain this 40% equity portion, 40% equity portion in their capital structure, company has to issue new shares. This is optimal capital structure. Make a maintain karanwa. Right? This is not changing. 40% from the debt, 40% from the equity, 20% from the preference share. So this is the capital structure. Right? So therefore, now they have only 40,000 retained earnings. Now their total capital requirement is 100,000. Then their capital requirement is 100,000. Right? You can identify the break point. So what is the break point? The amount of capital at which the WACC is changing. Simply that is the break point. So which means that the cost of one of the source of capital is changing. So break point you can calculate using this formula. Available retained earnings. Now, if you calculate in break point for this one, available retained earnings divided by percentage of the equity or the weight of the equity. Now, in this case, available retained earnings is 40%, 40,000. This company is another retained earnings in Hadarista. Available retained earnings is 40,000. Weight on the equity capital is weight on the equity capital. Capital structure ke equity weight is 40%. So divide by 40. And our first break point will be arise when the total capital requirement is increasing from 100,000 to above. That is the mean. Up to 100,000, 40% is sufficient to maintain the equity portion. Total capital requirement එක ලක්ෂ නම් 40,000 ඇති equity portion එක maintain කරන්න. Alright. If their total capital requirement exceed from the 100,000, 40,000 is not sufficient to maintain this 40% equity portion. So that is the first break point. The make break point here. So what is the break point? The amount of capital at which the WACC is changing. When the total capital is increasing from 100,000 to say 200,000, now the company has to issue new shares. The cost of equity is changing. MCC calculator. So that is the need. Now suppose again like this here, say make it in a Galle. Now the cost of debt here 11%. Right? Cost of debt is 11%. Assume that bank is saying up to 500,000, you can borrow at 11%. Bank if your borrowing exceed the 500,000, cost is 15%. So there is some limit. There is a limit. The middle break point condition. For you understand, company better up to 500,000 you can borrow at 11%. This is the cost of debt. But if the borrowing, if exceed the 500,000, so you have to take the loan at 15%. Another break point is there. Where? Available debt capital at the 11%, 500,000. That's a behind the then may formula retained earnings order. Make a retained earnings for any capital you can apply. So therefore better to write here available capital rather than saying the retained earnings. The main example is retained earnings in the I have put here retained earnings. Actually not the retained earnings. So you can slash and you can write here available capital divided by percentage of or the weight of that capital. Then if we make a debt on the up to 500,000 only you can borrow at the 11%. Now this is the available capital, available debt capital at the 11%. අපි ලක්ෂ 5ක් විතර 111ට යන්න පුළුවන්. එහෙනම් අපේ weight එක කියන equity debt capital වල 140. එහෙනම් තව break point එකක් දෙනවා කොතනින්ද? 500,000 divided by 0.4. Isn't it? 1 million. Yeah. 500,000 divided by 0.4. 1.125 negative. इधर मैंने प्रमाण कैपिटल एक्सीड වෙච්ච ගමන් 11% වලට බරව කරන්න බෑ. ඇයි බැරි මේ බලන්න. දැන් මේ අපේ total capital requirement එක. අපි how this finance this 1.25 billion කොහොමද finance කරගන්නේ මේක තමයි 40% from the equity, 40% from the debt, 20% from the preference shares. इधर බලන්න මේකෙන් 40 කියන්නේ කොච්චරද කියන්නේ 500,000 නේද? इधर मेन up to within 500,000 इधर इधर मे 500,000 नहीं इधर कर दे इधर नहीं इधर up to 1.25 million you can borrow at 11%. अब total capital लेकर company के total capital पे equity से exceed this amount का करना you have to borrow at 50%. It can mean the method up to 100,000. Either may 100,000 अभी finance करने को होगा 40% from the debt, 40% from the equity, 20% from the preference. Either 40% from the equity meaning 40,000. 40,000 retained earnings अभी का होती So up to 40,000. Retained earnings theory, 100,000 make it okay. But if you increase the capital from 100,000, you have to issue new shares. That is the break. Are you clear? Any question? Now we are going to calculate NCC and the WACC at every breakpoint, you can identify MCC. Now, if you look at this diagram, I have put it here to understand. Now, look at here. Then ප්‍රශ්නය AC ඕප කරලා right මේ බලන්න up to 100,000 in this diagram this is cost weighted average cost of capital. So this is total financing. Here in the x-axis total financing. I'll come to this point again after the calculation also. Idhar බලන්න up to 100,000, this is for our example. Up to 100,000, our WACC is 11.64. Right? හැබැයි අපේ total capital එක මෙතනින් exceed කරොත් අපිට අලුතෙන් stock issue කරන්න. එතකොට මේ බලන්න MCC, you can calculate MCC with the new stock issue. So then MCC, marginal cost of capital 12.04. Again you can calculate back with the new stock issue, that is 7.8. So likewise in this WACC, in the weighted average cost of capital, you may identify lot of breakpoints. Make a breakpoint. The may වගේ තැනකදී තව breakpoint එකක්. So likewise, එතන breakpoint එකක් එනකොට WACC එක උඩට jump වෙනවා. එතන MCC එක ඔයාලට හොයන්න පුළුවන්. ඒ විදිහට you will have a number of breakpoints throughout the WACC this line. Make a fixed number එකක් නෙවෙයි. It is zero. There are some expectation in the market, so they did that WACC is changed. Right? Galle. Ventilation is a caution. Right. Then අපි යමු මේකට WACC calculate කරන්න. Right. We are in the same example. So now we are going to calculate right. So are you clear about this breakpoint? එතකොට දැන් ලියන ප්‍රශ්නවලට උත්තර ලියන අය මේව බලා ගන්න. ගණන් හදන අය හැබැයි දෙකම කරන්න වෙනවා ඉබාක් පාස් වෙනවා. 50-50. Right. Then what is the breakpoint? Should be able to define. Right. So likewise, you in your own words, so you have to understand. So likewise, this is the breakpoint. Then after making your what is happening? Assume now ABC PLC, our same example, decide to raise additional capital 100,000. Additional 100,000. Total capital increase from 100,000 to 200,000. Compute weighted average cost of capital at which they can raise this amount. එතකොට at 100,000 we have calculated WACC, weighted average cost of capital is 11.64. Already done it. Now they are going to increase their total capital requirement from 100,000 to 200,000. Additional 100,000. Is there a total capital now? How much? 200,000. Right. So this 200,000. This 200,000, now their total capital is 200,000. How they are going to finance? Are they changing this capital structure? No, it is fixed. How they are going to finance? From the debt capital, 40%, from equity, 40%, and from the preference shares, 20%. From the preference shares, 20%. Right. 200 from 200,000 total capital, 40% means how much? Reduction say how many? Yes, 8,000. This is 80,000. අපිට එක්සල් මොකද ලිමිට් එකක් දීලා නැහැ ඉන්න ප්‍රශ්නයක් නැහැ. ඒතකොට equity again 80,000. Here 20 mean 40. So this is the way of finance. Now this 80,000 equity, the available retained earnings is 40,000. We have only 40,000 as our retained earnings. Internal equity 40,000. So therefore we have to issue new shares to raise additional 40,000. The cost of equity is changed. So then how this 80,000 they are financing? 40,000 from the retained earnings, another 40,000 from new stock issue. So if you elaborate further, it means that this 40% divided between internal equity and external equity, 20% from the 20% from the internal and 20% from the external. මේ 40 weight එක අර දෙන්න අතර බෙදෙනවා. From internal equity 20% and then from external by issuing new shares 20%. Right. So now we have to calculate at this 200 level MCC, marginal cost of capital, and the weighted average cost of capital. So at this level, marginal cost of capital or the MCC is equal. So what is the MCC? I am going to the definition again. Is the WACC, weighted average cost of capital, of the next rupee of capital is raised. So now, when we increasing our total capital from 100,000 to 200, additional 100,000 we are raising. Now we have to issue new share. We have to issue new shares. And on weighted average marginal cost of capital, you can calculate. මේ වෙලාවේ company එක අලුතෙන් fund raise කරනවා නම් අදාළ cost එක. That is the marginal cost of capital. So that is back next rupee of capital is raised. Now if they are going to increase from 100,000 to 200,000, MCC is equal debt, no any change. Cost of debt is 11%. You have to take it after tax basis. Weight 40. No any change from the previous. Cost of equity now. Now the company has to issue new shares at 17%. This is MCC. එතකොට දැන් අපි හිතමු company එක අලුතෙන් fund raise කරන වෙලාවකට අදාළ cost එක. දැන් company එකට අලුතෙන් issue කරන්න වෙනවා නම් දැන් මෙයාලට අදාළ cost එක 17%. This is the marginal cost of capital. This is the weighted average cost of capital of the next rupee of capital is raised. එතකොට relevant cost now for the equity part is 17%. Weight is 40. In the capital structure weight is 40 plus preference shares වල වෙනසක් වෙන්නේ නැහැ. 13% into 3. So this is the MCC, marginal cost of capital. Yes. Is it 11.04? Yes. 12.04. What is the answer? 12.04. It is 12.04. So now if this company is raising new capital now at present, this is the cost. 12.04. What is the problem? Huh? If you have any question, please ask that. The calculation confused, but after calculation you will realize this. Then we don't make company, we will control. Then retainer is even then company stock issue. So यहाँ के relevant cost है ना. If the company is issuing new additional capital, the relevant cost is now 12.04. So at the 200 level, I will show with this one. At the 200 level, now weighted average cost of capital. Now their total capital is now 200. Ask me what is the problem? Any question? Another sir. Any question? Right. Then total capital they increase from 100,000 to 200. इधर में additional 100,000 और first figure यहाँ additional capital they raise करना ना first figure 12.0 होता है. And in the prevailing market condition, this is the market expectation at present 12.04. इधर down for this 200,000 for the second 100,000 weighted average cost of capital is like this. Look at this one. I think I have no place to write here. Same formula. Now our total capital is 200,000. There are 200,000 of finance based on this. This is our way. 20 from the retained earnings, 20 from the new stock issue. So then you can see this is weight on the retained earning 20%. Weight on the retained earnings weight लेकर अपने समस्त प्राप्त करने के लिए 200,000 अपने को मतलब अपने company के दाम में इसका क्या retained earnings है. So that 20% from the retained earnings, the cost of retained earnings 16% plus weight on the new stock issue. Service sayapur. And the cost of new stock issue 17%. This is debt capital, weight taken after tax cost of debt plus weight on the preference shares, cost of preference shares. So this is our new weighted average cost of capital. For the 100,000, if our capital is 100,000, this is the value. अब इस तरह calculate करें 11.62. अपने कैपिटल लेकर 200,000 ना अपने दैट लक्ष्य का वैल्यू कराना अपने व्यक्ति का दैट 11.84. इधर बड़ा additional 100,000 और आपके cost में लाती है ना 12.04. This is the marginal cost of capital. खाली में व्यक्ति का NCC का देखो मैं का इतना NCC का कितना में है. But when you are increasing additional 100,000, so now cost is MCC 12.0. That is the meaning. Then after market take then after fund raise करना after 12.0 को cost का किया. So that is the marginal cost. So graphically you can present this like this. Look at this table also. Up to 100,000, MCC, back, both are same. When the capital is increasing from 100,000 to 200,000, additional 100,000. We are raising additional 100,000. Up a fund 100,000. But MCC 12.04. For this additional 100,000 not costing. 12.04. अब weighted average cost of capital 11.80. So we can present this one graphically like this. as I previously mentioned. Up to 100,000 back MCC both are same. When our fund is raising beyond this 100,000, I may 100,000 to a break point එකක් ආවා. අතගන්නේ 100,000 වල break point එකක් ආවා. retain earnings ඉවර වෙනවා 100,000 වලින් එහාට capital එක කියමු ගමු. එතකොට අපිට අලුතෙන් fund raise කරන්න වෙනවා මේ අපේ පළවෙනි break point එක. පළවෙනි first break point at 100,000 capital requirement. Either at the 100,000 you can see MCC is 12.04, back 11.84. So likewise you will have many breakpoints in future when the component cost is changing. So this is MCC and the weighted average cost of capital. I think that is the end of the cost of capital. We have discussed everything. So why you will have this question for sure in your paper? Why this cost of capital is important? In your upcoming reading chapter, this is explaining. So you have to read that chapter also, that section. Why the cost of capital is important? Because it's the benchmark in financial management decision for the investment decision, dividend decision. All of the decisions are affecting with the cost of capital. It is the discount rate in the investment analysis. Next, in our capital budgeting lecture, we are going to use this as the discount factor to evaluate the project. Return required by the investor. Investors require rate of return. So from the investor's perspective, it is the return required for them. From the company perspective, our cost. So that is our cost. And it is the minimum required rate of return on new investment. Minimum. That is minimum. Minimum mean minimum. The bettering ehata giyot tama value එක create වෙන්නේ. මේක at least අපි මේ rate of return එක investment වලින් generate කර ගන්නවා නම් මේ cost එක cover කරගන්න. So that is the minimum. So you should be able to explain the importance of the cost of capital using these points. I think that's all. I'm going to discuss few questions with you because in the tutorial we are not doing this thing. This one. Any question? This is end of the cost of capital. If you have any question, you can ask. I am doing a few questions with you, and then I am going to the capital budget. If you have any question, any clarifications, still you have, I can explain. This is your tutorial, I think. I have uploaded this one. Right. All this section now you can do. Right. So I am not going to discuss everything with you, but anyway, let's look at this one. This one and also this. Shall we discuss this question number 10? Make up the other questions you can manage, no problem. Dividend log model, capital base things, right? You can do yourself. Look at this one. Jane, PLC's capital structure based on the market values is as follows. This is considered to be optimal. Debt 30 million, common equity 30 million. During this year, the company plans to raise 30 million rupees and invest in new projects. The company issue new